In aerospace engineering, when you see this massive increase in complexity, you generally expect a massive leap in performance.
Right, like a more complex jet engine flies faster or
Yeah.
burns less fuel.
Exactly. But on Wall Street, complexity doesn't necessarily mean a better engine. Often it's just, someone building a more expensive toll booth.
Yeah, that's a great way to put it.
So when Goldman Sachs drops $2 billion on a fleet of, I think it's 159 buffer ETFs, the natural assumption is they've engineered a better financial product for you.
Which is what they want you to think,
Yeah.
obviously.
But today we're doing a deep dive into why they actually just bought that toll booth. And more importantly, we're going to show you exactly how to bypass their expensive options engineering to issue your own exchange-traded intelligent funds, or ETFs, using the Robbit and Bullpig AI engines.
Yeah, to really understand the play here, we have to look at what Innovator Capital Management actually built before Goldman bought them.
Right, the FLEX options.
Exactly. So they package FLEX options, which, for those issuing funds, are just highly customizable exchange-traded contracts. They use these to create defined outcome ETFs.
And the core pitch to clients is pretty simple, right? Like they cap your upside to provide a downside buffer against market losses.
That's the pitch. But here's where the math gets incredibly circular. Goldman Sachs is already the biggest market maker for FLEX options in the world.
Wait, really? So they're feeding themselves.
Completely. They aren't just buying fund management fees, they're buying a $28 billion captive pipeline.
Wow.
By acquiring Innovator, Goldman guarantees this massive, constant flow of complex options trading going directly to its own trading desk.
It's like buying a massive fleet of shipping trucks just to guarantee traffic and tolls for a highway you already own.
Yes, the ETF wrapper essentially traps the capital right inside the Goldman ecosystem.
Okay, let me actually just share my screen here with you guys because I want to pull up the Robbit macro dashboard so you can see exactly how much that ecosystem costs.
Yeah, pull up QTOC.
Okay, QTOC, their Growth Accelerated Fund. So Robbit evaluates the structural efficiency, and it gives QTOC a positive 2, which, means it's mostly doing what it claims.
It is. But look right below that at the Bullpig dashboard. This breaks down the micro level, like the 5-minute tick data.
Right, the 100-unit rows chart here.
Exactly. That chart maps out where the returns are actually coming from, and it shows those complex options are just a massive performance drag.
Yeah, it looks like the fund's real alpha isn't options math at all.
No, it's just sheer concentration. Bullpig strips away all the noise and reveals the fund is practically mimicking a portfolio that's vastly overweight with 37 units of Goldman Sachs stock.
Wait, so if you just issued a static ETF basket holding those exact underlying stocks,
You beat their complex fund by 7.45%.
that's incredible. Okay, let's scroll down to BSEP, the S&P 500 buffer ETF. Robbit gives this one a brutal -10. But let me push back a little here because, psychologically, institutional clients love feeling insured.
Sure.
Isn't paying for a 9% downside buffer worth the cost for risk-averse capital?
I mean, psychologically, sure, but mechanically, the math is just brutal. Look at the probability curve on the screen right there.
Oh, wow. Yeah.
Because those FLEX options ruthlessly truncate market surges, an uncapped, simple ETF actually beats this option strategy 98.12% of the time.
So you're literally mathematically strangling your compounding growth just to pay a massive premium for redundant insurance.
Exactly.
Well, so if the options are a drag on domestic growth, you'd think the real value of these buffers would be in highly volatile arenas,
Wow.
right? Like emerging markets.
I think so.
But let me switch the screen to EOCT, their emerging markets power buffer. And it's even worse. It scores a dismal -12.
This is where it gets super fascinating. When Bullpig analyzes EOCT, it finds the actual return driver isn't emerging markets at all.
Wait, what is it?
It's defensive U.S. blue chips. Specifically, the data shows it mimics holding 30 units of Coca-Cola.
What? How does a complex emerging market option strategy end up behaving exactly like holding Coke?
Well, it's because of what capping and buffering actually does to a volatile asset. When you slice off the high highs and cushion the low lows using FLEX options, you're mathematically flattening the volatility.
Right, you're just compressing it.
Exactly. You are artificially engineering a return profile that is practically identical to a low beta U.S. consumer staple.
Wow. And you see the exact same illusion with IOCT, the International Development Fund. Looking here, it scores a -9. And the Robbit chart visually displays this massive 13.11% alpha gap that basically just gets forfeited to those upside caps.
Right. And again, Bullpig proves that international alpha is largely just mimicking 19 units of Procter & Gamble.
That's
The
crazy.
international options wrapper is literally just an illusion masking a standard domestic blue chip foundation.
So taking all this in, what does this actually mean for how you manage capital? I mean, the strategic takeaway here seems to be that you don't need Goldman's expensive wrapper.
You really don't. You can issue simple, static ETFs that replicate these exact factors without all the frictional cost of those FLEX options.
Right, and ultimately capture much higher returns for your clients.
Exactly.
Which brings us right back to our toll booth analogy. I mean, think about this. If a $2 billion Wall Street options machine can be consistently defeated by an AI-generated static shopping list of traditional stocks, are investors currently paying for actual expertise or just the illusion of complexity?